So let me give you a scenario that you're probably familiar with. Jerome Powell comes to the mic, says a few things about the economy, and the market goes absolutely crazy. But have you ever wondered, why does the Federal Reserve have so much power? In this video, we're going to discuss everything about the Federal Reserve and why they have so much power. So the Federal Reserve is actually the U.S. central bank. This was created by the Federal Reserve Act of 1913. It was established as a monetary system to respond effectively to stresses in the banking system. The Federal Reserve System includes the Board of Governors, which is an agency located in Washington, D.C., and the 12 Federal Reserve banks around the country. Now, it's very important to note there are 5 key functions of the Federal Reserve System. It conducts the nation's monetary policy. It promotes financial system stability. It supervises and regulates financial institutions. It fosters payment and settlement system safety, and it promotes consumer protection and community development. Now, important to note, also a part of the Federal Reserve System is not only the 7 governors, but there are 12 members that make up the Federal Open Market Committee, better known as FOMC. Now, FOMC is a very important committee because they help set crucial monetary policy across the U.S. The 12 voting members of FOMC include the 7 governors of the Federal Reserve System, the president of the New York Federal Reserve Bank, and 4 of the remaining 11 Reserve Bank presidents. So let's get into the duties of these groups of people. The 7 governors of the Federal Reserve are usually appointed by the President of the United States for a 14-year term. In addition to that, a chair and a vice chair are appointed to the Federal Reserve. They will serve for a 4-year term and can even be elected to an additional 4 years. The chair of the Federal Reserve is going to guide the operation and promote the goals of the Federal Reserve System. Now, the 7 governors of the Federal Reserve are also going to oversee the 12 reserve banks around the nation, and on occasion will also report to Congress to give details on how the economy is doing as a whole, and also what they have been doing to improve the economy. Now, moving on to the 12 Federal Reserve banks. Although they are overseen by the 7 governors of the Federal Reserve, they do also operate independently as well. They perform duties such as supervising and examining banks and other financial institutions. They enforce compliance with many of the banking laws, and in addition, they will also lend to these banks to make sure there's enough liquid in the system. Now, moving on to the FOMC, the 12-person group of the Federal Reserve. FOMC sets crucial monetary policy at meetings that they have 8 times a year, and the things that they set in place can have profound effects on the markets that traders tend to see after the news has been released from their meetings. Many traders are familiar with the functions of the FOMC, the key one being influencing the interest rates of the economy. Now, as you know, changes in interest rates will have a profound effect across all markets. Not just trading markets, but almost all markets are affected when interest rates change. Why are they changing interest rates, you might ask? Well, it's always going to depend on their analysis of where the economy is headed and what the economy might need. So if they feel the need to raise interest rates to limit the spending in the economy, maybe because they can foresee a recession happening, they're going to tend to do that. Even though it's going to have profound effects on the economy, this is their way of trying to make sure that things don't get worse than it currently is. Now, when FOMC decides to lower the interest rates, it tends to point to a sign that the economy is doing pretty well and that inflation is also going down. As a result, in the economy, you'll tend to see more spending overall. Now, if you ask me, that's quite a bit of power for one group to have, because the news that comes out from their meetings tend to shift the economy drastically. So ultimately, guys, it's really important that we as traders, when we see FOMC news is actually coming out, we need to be alert, we need to be informed, and we need to make sure that we're putting ourselves in the best situations possible to capitalize on those trade moves. Now, in addition, on days of FOMC and interest rate decisions, the market is extremely volatile. So if you're not used to trading around these times, I would definitely caution you to be very, very careful. I would even caution you to wait till after the release has happened to allow the market to move and settle before you start taking your move moving forward based on the data. As you can see, the Federal Reserve has a lot of power and a lot of influence, not only on traders, but the economy as a whole. It's very important that we continue to stay informed and understand all the things that the Federal Reserve are doing and have decided on that will change the economy as a whole. So guys, if you like this video, please like, share, and subscribe, guys. I'd really appreciate it. And until next time, peace.